about today. A lot of good tweets this week, and the markets are great. The trends are great. Oleg.
Hi, Jerry. Hi, Richard. Hi, Alp. Hi, De Bonnet. Hi, Cardura. Hi, Marcel. Hi, yes, it was not easy to pronounce for me. Yeah. But I can pronounce Mark Zybrzynski. I can pronounce this. And nobody can pronounce the surname, the second name of Mark Zybrzynski. So I can do this. Yes, because it's Polish surname. So, and we in Russia, we have a lot of people with Polish background. I have told about this. So it's okay for me to pronounce such surnames. So it's today is happy Thursday, as usual. It's happy Fridays for me, and I thought it's Thursday today. Why I'm so happy? And then answered to myself because trend following plus nothing ideologies are coming soon. So it was maybe an hour ago, and a few days ago I was asked. Can I imagine for myself to stop being a trader? And I answered, of course, no. Even if most of the money of the whole world will be mine, I will not stop being a trader because I love it, and I will not stop. And even if it will be theoretically unpaid profession, I will not stop because I'm not doing it for money. First of all, not. And I'm very happy with this. Trading process is something that gives me happiness. It's a great thing. It's a great philosophy. It gives happiness. It gives great friends. It gives everything, I think. So it really, and I'm always happy to be here. I always say this because it's really so and awesome. So this week, I was very impressed with podcast, new interview with Jerry. Of course, yes, of course I was, and so I want to. And with this, that Jerry said that we don't want to pay too much attention to the past performance of any of these markets. We think that they're all trend eventually, and you can't really predict these things about when and how it's going to trend. So it's really is just seeking out companies that maybe have a commodity relationship, or we think that they're small enough, that they can have a big trend. Maybe just a company that's not well diversified. That would be very helpful. We don't want a company that has many different business lines. It's probably going to be better for a company that has one business line to get a big trade. Something fundamental will happen in this company, and with supply and demand or shortage of who knows, but then that may send it off on a big huge trend versus a company that's very diversified, multiply lines of business. So I was very impressed by this. It's really very interesting. It's insightful. It's it's very insightful. In this stock picking, maybe not the right word, but philosophy of seeking of the goods of finding the better stocks. And I think yes, because past performance is nothing here, and this idea with one business line, with concentrated, I want to say so, concentrated business. I think it's a very great idea, and I really like it. And I never heard about this before, and as I remember, I don't remember. So I was very impressed. So let's get started. Again, very happy to be here, always.
Oleg, thank you. I think you could absolutely have your own show, your own spaces for sure, and do a really good job. And, it's a warning for the rest of you guys. If you're on podcasts, your own spaces, you're doing lots of talking, Oleg might be there to replay it all back to you. So be careful what you say. Make sure it's correct. And of course, Oleg's impressed by what I say, but not always perfect and correct. And I posted this week a really good chart. I thought it was very interesting, and there's a good story behind this chart. I was giving my son some pointers on how to trade, and I was just teaching him this breakout strategy. And he has been trading his stock account, very little money, stocks and ETFs, and following the trends. And he told me, like, this has been like a year ago. And so he told me last weekend, he's like, I have this big stock and I made a lot of money on it. I'm like, really? He goes, yeah, I just followed the trend and I never got out because my parameters of breakout, you told me, it's never been hit yet. So I just stayed right in. And I posted this stock. It's Eli Lilly. And so it's a really huge company. So this is one of the best trends of all time. And an example that the exact opposite of what Oleg said, that because Oleg was quoting me correctly, that I sort of prefer, or I think, well, maybe the smaller the stocks, the better. But here's an example of where, even if that's correct, there's an exception here, and this is a very large stock. It had a very large trend, and I could not believe how impressed I was by my son, because he crushed this thing. He never got out, and it had a pretty big drawdown as well. I mean, a pretty massive drawdown. It was not a big drawdown in the context of the chart, but still, it would have freaked anyone out, and possibly made them wonder why are their pants so loose. And I thought this was just a great thing to post to show the power of trend following and trend following stocks. Of course, it makes no difference what market it is really, and what happens and what that looks like and what it takes to get those big huge trends, like Eli Lilly. And it's just something we're all looking for. And yeah, I thought that was a pretty interesting situation. Also, we have some comments and questions. I see Tyler's on. I don't know if you want to talk about your question, Tyler, and your comments that you were making, but you're welcome to do so. Tyler was bringing up this idea of forcing me to comment on whether short exits are more important than longs, which I don't really think is that interesting, but everybody seems to be way more interested in that than me. But so I think that it's all important. Good morning, Tyler.
Good morning, Jerry. Can you hear me okay?
Yes.
Yeah, so I appreciate your response there. I appreciate you disagreeing. Makes me think about it more. So I said, made a statement that I thought that the exit was more important than the others, and then obviously responded and said that entries, exits, and stop losses are all important, equally important. And the exits can seem more important due to the P&L variance on individual trades, but over the entire data set, systems with their different entries and exits make about the same amount of money. So my follow-up question would be this, and obviously it's not realistic because you wouldn't have to do this, but just for the fun of it, if you were to have to choose either the entry, exit, or stop and randomize the others, which would you choose?
That would be an unfortunate situation. I definitely would not choose stop loss. I don't know though. The entry and the exits that I have, the average loss without a stop loss equals my stop loss that I've chosen. So, but that's going to go possibly haywire and not be the same if I have a random entry. But I think I would honestly choose the exit, but I don't know if that makes. So maybe I'm agreeing with you that I would choose the exit because I think it's really important, without doing any research, to stay in the trade, a long time and have those loose pants and allow that trend to run. But having these random entries and stop losses might I think I would prefer to take the stop loss off, possibly. Hopefully I can trade lots of markets so I won't get crushed. But nothing's as important initially as putting that trade on, not having a filter to get in that trade. Nothing's a go. A type 2 error where you're missing a trade is no good. We have no defense for a type 2 error. We have lots of defenses. Well, we have our main defense for a type 1 error, which we make all the time. 60% of our trades are type 1s. We do something we shouldn't have done. Obviously we didn't know, but it ends up being something we wish we could have avoided, the loss, and the stop loss kicks right in. No brainer, no stress, piece of cake. Hopefully you trade 300 markets, small bet size, it's irrelevant, pretty much irrelevant, each individual trade. Like I said, the stop loss, I like it, I use it. I've never not used a stop loss. When I optimize the stop loss, I change my opinion from take small losses, which I think the stop loss we use is small loss, but I think it's pretty accurate to say it's an optimal loss because we just optimized it. And ironically, optimizing the stop loss, the number of ATRs, gives you an average trade, an average loss that is almost the exact same number as trading without a stop loss. I don't know if that means anything, but it's interesting. And then the entries are not very controversial. Like all the entries, I think, are pretty much, the ATR. The quicker you get in, the lower the ATR. That's a big benefit on your shorter term, long term systems. And then the longer term, you are maybe the higher on average your ATR is, but you avoid more trades and more false breakouts. So, but like I said, they all make about the same amount of money at the end of the day. Now, what comes into focus is all these big outliers we have on at this moment: cocoa, sugar, orange juice, Eli Lilly. And once it becomes a big outlier, the breakout exits start to spread out more. They're bunched up in the beginning. It could all be the same number when you first put the trade on. Every breakout exit could be the same number. But then as it gets to be more and more profitable, the breakout exits spread out more. And it becomes more interesting because the short-term system is going to get out and book that profit. And it could be a much different profit than the longest term trend following system that you're using. So on any individual one trade, it really looks like it's a big, huge difference. You have to nail this trade. You've got to get it right. No, you don't. Because you're trading multiple systems. One of the systems is going to make the most amount of money, maybe a dramatically more amount of money than the other systems. But overall, over all the trades, over your 20-year career, 40-year, 30-year career, or whatever, they're going to make about the same amount of money. So it doesn't really matter. There's no reason to optimize or to be interested in a specific exit. Only in this emotional sense that you're really concerned about the current trades and the current clients and your current money, which is something you should not be too concerned about.
And I want to say, and maybe I have said this before, that I have mentioned that, and it's very interesting for me at least, that, for example, if you have 1 ATR daily stop loss, and the situation you have 1 ATR stop loss theoretically, and you have 10, for example, plus 10 in a year, and maximum drawdown was -3. So theoretically, but if you have, and if you have 2 ATR stop loss, the same system will show 5 plus 5 annual result, and maximum drawdown -1 and 5. So I mean that the less the closest to price, the more close, if your ATR stop loss, the more close to price it is, the more risky you are. And I have done tons of research on this topic. So, I said many times that if you're trading short term, you risk more. For example, if you're trading in a short-term space with 1%, it's not the same that trading in a long-term system with 1% risk. It's not the same. So if you have, for example, one ATR stop loss, and if you have 3 ATR stop loss, when you have one, you risk 3 times bigger, but your profit also will be 3 times bigger. So it's maybe the situation is the same if you understand this, but if you trade short term, you do more trades and you pay commission for this. At least that. So here's my views, my points, results of my backtesting.
Definitely understand what y'all are talking about, and focusing on each individual trade versus the entire system over the course of 20 or 30 years makes a bigger difference rather than really focusing on each individual trade. Yeah. So you said in your response to me about the variance of the individual trades, but if you were to isolate for entry or exit, and then run an parameter optimization for the other, would the variance be higher for the entry or for the exit? So if you chose the entry and then ran the optimization for the exit, and then vice versa, would you get higher variance in the risk and return metrics for one or the other?
Yeah, right. I think that it would definitely be the exit, but I guess it depends upon the how much data you're looking at, because but I think on any individual trade, yeah, okay. So if you isolate, if you just look at, yeah, so yeah, I think I understand where you're going, but once again, I think the you get the big trends, then this is where the correlation analysis kind of breaks down. Like you go to your clients and you say, oh well, heating oil and crude are 90% correlated, so I'm just going to trade crude. And then, but you look at the P&L of a crude and heating oil trade. The P&Ls could be vastly different, although the markets were 90% correlated in some sort of hypothetical uptrend. And the same with the systems. The systems will be 99% correlated because they're long, and these long-term trends for most of the time until it kind of reverses, and then you'll get some massive differences. So correlation kind of breaks down in the real world where people care about the P&L and diversifying that P&L. But if you pay attention to the correlation of a trade that you've been in for, all your systems are in for a year or two, the correlations are almost perfect. But when it's all over, the correlations can be very different. Giving up that initial entry, it's good. It's good to get out quicker on some of these trends. You feel better about it. You want to book this profit, but even if it's a system that the computer likes and is part of your group of systems, but one of the things that feeds into it is that giving up that initial entry and having to resize it if the market goes back to a new high. So, keep staying short the short-term interest rates that you put on a year or two ago. With that very artificially low ATR, you've got this gigantic position, and it's just making money. And so, you have to get out based on the system. But as soon as you get out, you're going to have to go short again. In this particular trade, you had to short it at the lows again, and the ATR is way higher. So you got such a smaller position on. So this feeds into the computer in the back testing, kind of saying like, yeah, all these systems are kind of created equal. You give back more profit on the longer term systems sometimes, but you hold on to that initial position longer. And when it keeps going, you just, you crush the other systems because they get back in, haven't gotten out before the trend really ended, and then they have to put on these smaller positions. So it's kind of phenomenal that optimizing doesn't even work or help. There's no need for optimizing. because within this range of 100 to 200 or 300 day breakouts, maybe 75 day to 300 day breakouts, they all make the same amount of money. And then of course some smart person could say it's not about that, it's about Sharpe. So what is the Sharpe, or what is your risk metric? And mine is, the win-loss ratio, kind of like for every loss, for every dollar I'm betting, how much am I making? And so I don't pay attention to these drawdowns and or volatility. It's kind of amazing to look at these charts too. They're very educational, and you can kind of see and live through these massive drawdowns and see the markets recover enough. And of course, the computer says that, look, yes, you have these big drawdowns in these long-term systems, but trade them, because historically, when they've had drawdowns, they have a tendency to recover enough to be superior ways of trading. And for every like Eli Lilly you get, you're treating all these markets the same. You're picking up on the good trades and the bad trades. And so I have a really bad trade that, using the same parameters that I would use for a big trend like OJ, Coco, Eli Lilly. And I never said I was long Eli Lilly. That's pretty funny, I just kind of put it out there. You got to read Jerry's words very carefully. And people were like giving me props for being long Eli Lilly. And I was like, I never said I was long Eli Lilly. I just said trend following with these particular parameters that I posted, 200-day breakout. I cherry picked the parameters so it would stay in there the whole time. But you get the good with the bad, and you average it and you add it all together, and you see what the results you get, and the reason you trade the long-term systems. But then we have this one trade, feeder cattle, that I am long, and it has just crashed. I mean, it was a nice trend for like a year or whatever, and now we're giving back every single bit of profit. I mean, every day it's just crashing more and more. And so, the tendency would be, okay, how do I come up with a metric that keeps me in Eli Lilly, but gets me out of feeder cattle, because it's absolutely crashing. And it's not going to recover. And I agree, it probably won't recover and go higher. But, Eli Lilly, by my calculation, had a 48 ATR drawdown. And that's an outlier for me, like a 50 ATRs, that's getting into outlier territory. And so that breakout system is just so amazing and horrifying that it would sit there and give back that level of profit, which on that chart of 680 ATRs max profit that it had, it's pretty close to the high still, that you had to, in order to get that 680s, and it's just open profit, you had to sit through a 48 ATR using an entry ATR give back in order to get that. That's absurd. It's absurd. And it just, I think in one ways, it makes me grin, because it probably is like this ultimate safety of not having people want to copy what you do and sort of say, oh, I need some vol management and some correlation management in order to feel better. Clients want it. Oh, clients want it. It's not me. It's other people want it. My clients, they don't want to sit through a 48 ATR drawdown. I mean, it's just in one particular position. That's overwhelmingly profitable, and one of the greatest profits of all time. And in order to get that profit, at least the last 1/3, you've got to really suffer some pain.
Jerry, can you hear me now?
Yes, I can. And I was just thinking we should mention our get-together in Sydney later next month. I'm going to be in Sydney with the Moritzes 1 and 2, and Adam and Richard, and at our event in Sydney.
Many wines will be had and great chats.
I know. We're going to have a good time. Got a lot of friends from the past showing up, and going to meet some new friends, and we're going to start this is the Aussie leg of the Turtle Tour. Because we're going to create turtle chapters all around the world, probably. What do you think, Rich?
Well, I think that's the plan, Jerry. So we're going to do a bit of a planning session down there as well to revitalise the turtles and get it spread around the world. But Jerry, in my last monologue, which I think was probably my best work ever, how much did you hear of it?
Close to zero. So, but we're
It
waiting.
was my best work.
I know. So, it's kind of like a Broadway play where you've got to do it every night for like a year. So just redo it, Richard.
All right. So I was responding to Tyler, and I was basically nodding my head at everything you said about the importance of all aspects of the trading strategy that we deploy. And so how I'd phrase it is that I consider myself an outlier hunter. Now, what I'm doing there is I'm distinguishing myself from other forms of trend follower. So I'm particularly classifying myself as someone who's seeking absolute momentum, not cross-sectional momentum, someone who's got a particular technique that is targeting specifically outliers. It's not concerned about other aspects of trend that you might find in other areas of the distribution. It's focusing on the outliers found in the tail regions of the distribution. So what that requires is particularly from my testing and my research, is it requires a trend following strategy that is either on or off. It's not one of those trend following strategies that is in the market at all times. It's one of these that is particularly selective about when it enters into the market and how it holds that position and how it capitalizes on the profit opportunities from uncertainty. So with that aspect, all aspects of my system are very important. So I also trade an ensemble of systems. So what that means is that the entry and the exit and the stop and the trailing stop are all different for each of the ensemble of trend following systems that I deploy to target these outliers. And the reason I'm doing that is that as an ensemble, it allows maximum degrees of freedom to capitalize on outliers, which are these crazy anomalies that can do really weird things and defy the Gaussian statistics and traditional statistics and do these amazing things. So therefore you need very loose pants. So a single model to me doesn't have sufficient loose pants to capitalize on outliers, because you might get these type 2 errors all over the place if you're focusing on a single model. With an ensemble of models, however, the reason I'm deploying that is twofold. One is to get an uncorrelated suite of trade results from trading a single market using an ensemble of trend following systems. And having this uncorrelated result from the actual systems deployed for a single market, it means, therefore, I can trade a much greater expanse of markets themselves that might be considered too correlated by other forms of trend follower. So, Brent crude I trade because each have sufficient variation, even though they're very highly correlated with these unique systems I deploy, to get outliers in one and not in the other. So you not only capture more outliers through this particular process I deploy, but also you get this less degree of correlation in the trade results. And that is peculiar for the particular type of trend following I do, which is cutting losses short, letting profits run in this chaotic region of the tails. And I think that all aspects, all variables of my simple systems are as important as each other. Exits, of course, are important. Entries are incredibly important. Small bets, making sure that our losses are always, only ever linear results. We never stray too far out to the left tail region of our tail results. The idea of our entire approach is to have this extreme positive skew, as much as we can get of this positive skew. And to do that, you've got to stop that sort of adverse, non-linear result in your trade distribution and capitalize on the beneficial positive skew of the trade distribution towards that right tail. So, I hope that answers the question, at least from the perspective of an outlier hunter. I can't say the same for other forms of trend following, because each form of trend following is capitalizing on different aspects of trends, such as cross-sectional, all of these aspects. I'm focusing on a particular class of trend. I hope that makes sense.
No, it does. I appreciate the the answer on that. Unfortunately, I've got to go. I look forward to hear the rest of the recording. Appreciate it, Jerry and Richard and Oleg for the responses. Rich, I asked you if you said the event was free in Australia. I asked if that meant flight included. Let me know if you want to take me up on that offer.
Yeah, no, look, I really appreciate that, Tyler, but how about we come over to you?
Looking forward to it.
So where are you in the US? Okay, all right, Atlanta, Georgia. So yeah, it'd just be a small hop, skip, and a jump from Jerry. So when we're over with Jerry on his side of the stretch, we just pop over to you and meet with you, and you bring the Atlanta crowd along.
Look forward to it. Thanks, guys.
All right, mate. Thanks very much.
Hi guys, how are you? Can I ask you a question regarding what you just said and what Jerry said about stops? Did you ever consider not using the stops? I had a question about what you said, Jerry, about that the systems were almost the same, the statistics. Do you mean that in the equity curve or in the trade stats were almost the same? And did you ever consider not using stops? Because one of the bad things about stops would be slippage or more than slippage when things go sideways and you lose money. And since you notice that the stats are mostly the same, would you ever consider doing that, or does it have to do with what Richard just said about not exposing yourself to a nonlinear adverse result?
Right. I never really considered not using them. You know, a lot of the managed futures CTAs with all of the extra vol management, correlation management, relative strength stuff, you know, they lose track of the discrete trade. You know, there's really no discrete trade. You're putting it on and then you're taking it off based on different factors. So they don't use stop losses. And then I sort of started saying the words when I was trying to be a gentleman to, you know, in conversations with those type of traders, I would say, instead of saying stop loss, I would say take small losses. So I think they probably take small losses, but they don't use a proper trailing stop, which, you know, is kind of implicit in you'd have to probably have some sort of discrete entry exit stop loss. But it's the equity stats. You know, they make the same amount of money, but the trade stats would be a bit different. You know, and trade stats are not easily comparable. I mean, there's no reason to only trade the systems with the highest trade stats, because it's a range of, you know, minimum expected return necessary, because the trade stats are heavily influenced by the number of trades. So since they all make the same amount of money, the shorter term systems trade more, so their average trade is a bit less. So only paying attention to trade stats. I mean, I look at the equity stats and I think that that's interesting, and I'm happy about them. I expect that the equity curve could be a lot worse in the future. The drawdowns could be a lot worse. I don't really want to rely upon that equity curve. I like to rely upon the trade stats, which don't have that much information in them. But it's not a question of trying to only trade systems with the highest trade stats, because it's really kind of an illusion to a degree, because in the sweet spot of systems, breakout systems, the trade stats are influenced by the number of trades. But yeah, I think it's a question of, I think it's important to try to think of things to put into your system that the back test says, you know, you really don't need to do that, you know, but because we haven't seen an issue with not using trailing stops, let's say. You're still alive if you don't use trailing stops. So my idea would be, oh, okay, thank you, but I think I'll use them anyways, because there could be a period. I disrespect the back tests so much that I'm going to use them anyway, even though it says you'll make a little bit less money, let's say. I don't think it does, but let's say that it does. So I discount this back test. Not only do I not pay attention to it, I discount it and I disrespect it as much as I can by saying I'm going to do it anyways. because it's a break even. And so if it's a break even, risk control, risk management is a break even, I'll choose it, or a slight negative, I'll choose it in order to possibly prepare for times where you're going to have a lot of losing trades that are going to go a lot further than your stop loss. And that could be a painful period that you'd want to kind of avoid. But it is a pain in the ass to get into a trade and get out and then get right back into the same direction just because of a stop loss, but such is life.
If you're in a predictable trending regime with these nice, well-behaved trends that sort of have sort of mean reverting elements of an overall trend direction, then yes, I can see why people that would trade that form of trend might not use stops, because they'd use some other performance-based exit. So if you're coming out at a stop, you're automatically introducing drawdowns into your portfolio. So I can understand that. However, because we are deploying our techniques in a chaotic regime where things aren't nice and predictable, you don't necessarily get the nice mean reverting character, the slow building trend. When you look at sugar, London sugar, you look at orange juice, and you look at the nature of trend they've formed over the last 3 years, it can't be regarded as a nice, well-behaved trend. It's quite erratic. There's been quite highly volatile components of it. So the reason I use stops is that if I'm in a chaotic regime, I do not want to introduce adverse nonlinearity into my portfolio. Furthermore, the stops, rather than being a fail-safe, it's a small bets of the fail-safe that preserves that basically gives me the linear adverse result. But the stops are to release risk in the portfolio, to prevent any individual return stream in that portfolio start to excessively contributing to risk to the overall portfolio. So in these chaotic regimes where you don't use stops, there can be situations that arise where suddenly you're facing this extreme event, adverse event. Your performance exit hasn't been hit. You're suffering from an extreme drawdown that is many ATRs further than what you originally anticipated, that starts sort of wobbling the portfolio, putting undue risk in certain areas of the portfolio. And the whole intent of a diversified portfolio for an outlier hunter is to have a vehicle to trade chaos. In other words, a vehicle that is continuously releasing risk from the portfolio with these short stop losses. To continually release risk. So it's always in a capacity to absorb future risk as opposed to warehousing risk in the portfolio.
Yes, I fully agree with I like this and I want to say that it's I've said before that it's a very beautiful thing when you enter the trade in a long-term system with a low ATR and low pips, and after that it began trending and you don't change nothing. You came there in this trending environment with a low ATR for 1 year, for 2 years, and really it brings the most amount of money. I 100% agree with this. Yes. And of course, in the short-term system, we can enter with a low ATR and then we sold and enter another trade in the same direction with a higher ATR. So of course it's robustness suffer. I agree with this. So and we're less performed. So with a more problematic, more complex way, by the way, in executing this, I agree. So really, it's very beautiful. And stop loss, I love stop loss. I love using this because my system enter exit.
I post a lot of tweets and they don't get much attention, rightfully so. But sometimes when I'm under the influence of wonderful wines, I just get into a kind of a confrontational mood and I want to post something. And something comes into my head. And I'm trying to think of the most controversial thing I could possibly post to get a reaction out of people and see if I can. It needs to kind of be true.
I loved your post on the death of ESG. I really like that post.
I know, and ESG is something I don't really care about, or it's dying or living. but I knew it would turn some people on. I guess there was a funny quote in there, and I like the guy who wrote that article. He's a really smart guy. I've tweeted his stuff before, but oh yeah, this is one got a lot of interest, and I wanted to see if you guys could figure out where I was going with this without giving you too much information. And you have to have your trend following ideologue hat on. You got to be deep into your trend following, and trend following is our world and the only world that we think matters in trading. And okay, here goes. And I don't have research on this, so I started by saying I'm guessing. My guess is that a long-term trend following strategy applied to a portfolio of value stocks would have an average entry price lower than the average value investing pro. So we buy lower than they buy. We're not even value. I don't even know what value means. I don't think it's objective enough for me. But let's say we had an objective way and we have a portfolio and we're only going to trend follow value. I think that the trend following, buying the highs, we're going to buy the highs in these things, right? Whatever high that is. Even though we're buying the high with our trend following, we would have a lower average entry price on these stocks, these value stocks, than the value investing people who don't use trend following. Then I go on to say the trend following strategy. Oh yeah, the trend following strategy, of course, it doesn't miss any of the big value stock moves. The average value investor, they would miss all kinds of moves, right? Because they've got this value perception, and if it got a little bit overvalued, they may miss it. But we would just be buying the breakouts. It's not as much value as it used to be. I think I'll wait for it to sell off more. We'd say, no, we're not waiting. It hit our entry. So we're going to hit even more of these value moves than they would hit. So our average entry price is lower, and we're getting more of the value stocks by trend following than the value people. More of the value stock big trends than the value people. And I got some pushback on this, thankfully. Cordura, I don't know, he commented on this. Maybe he wants to comment now.
Yeah, I thought that I think that the way that the value people suffer, it's very different from our way of suffering, right? Because as Howard Marks says, you enter positions and then you feel all the time that you're wrong, and you have to be prepared to lose 50% of your money, and then gaining again, and then have a good P&L. But at the beginning, it's very different from cutting your losses short.
That's right. Not cutting their losses short, and therein starts to uncover the problem. They're continuing to buy all the way down, and that's why we have a better entry probably, because we're not buying all the way down. They're certainly buying. Some of their prices are definitely lower than the breakout we'll be buying, but it gets back into this situation. Can they predict? I don't think they can. They're not using as good a systematic approach, or any systematic approach that I would consider to be a good one, like we are. And so our trend following is, our price is absolutely going to be lower, because buying the 100-day high or whatever is going to be in a consistent basis. I'm guessing is going to be better than continuing to buy lower and lower, and it's a really unfortunate risk control situation where, in our world, buying that breakout, if it goes against us enough, it's a bad trade. We get out. Bad things cannot spin out of control too much in that scenario, versus continuing to buy the downtrends. As it gets more and more value, more and more valuable, it becomes a better and better trade until, it's not a good trade. And they suffer these big, huge losses on some parts of the portfolio that we don't. It really just gets down to the point, is there anybody, not just trend followers, is there anybody who can predict what these markets are going to do in a way that's better than following the breakouts?
I think that their governance is very different than ours, because they can, comment about the decision they made and think that they're good, because they see the balance sheet. They see, in fact, they have a different way of screening what equities are they going to trade, because the huge difference is at the beginning, the screening, the universe that they use. Because if they go down 50%, they will say, well, I mean, the cash is there. There is no debt on the company, etc. So we can feel safe that we made a good decision. And in our case, it's totally different, because you say, I feel safe because I'm cutting my losses short, and I'm doing the right thing. So it's two ways of managing the governance of the strategy and your assets.
But you can get value investors who effectively use value as a basis for their selection process, and then they might incorporate trend following or a breakout into when they actually initiate into that trade. So, I know Art Holly does that. He would class himself as a trend follower, but that's his method of, stock selection, where he's using sort of, fundamentals to do his selection for his universe of things to trade, and then waits for the breakout to participate in that opportunity with what he believes is the backing of fundamentals or backing of value in his decision. So, I can see why he'd do that. We don't do that. We're simply working on price, because we recognize that, things that can't be correctly valued are often the things that offer us the biggest trending opportunity. Things such as cryptocurrencies, things such as, the weird moves we see in price that has no sort of fundamental rationale behind, backing it. It's just, behavioral sort of impetus of the market. And, I think our opportunities are greater with the fact that we simply follow price with a breakout. But I certainly see why certain classes of different forms of, trader might include fundamentals or value as a basis for screening, selection, that sort of thing.
Yeah. Hi, guys. Yeah. So to comment on, I agree with Jerry's conclusion that the entry price would be, the average entry price would be better with a momentum strategy than just a fundamental trader. And this is actually can be confirmed. I've run back tests maybe 10, 15 years ago when I was trading at banks and funds. I was running strategies with also factors, and momentum was always one of them. And what was fascinating about momentum is that no matter what else you may have as a statistical edge, as a proven statistical edge that you can prove you have it, is improved when combined with momentum. And this includes value. So value guys without momentum, without price confirmation, are actually catching falling knives, and they get their hands blooded. And where the performance suffers there is that the higher entry price, because a value stock enters their universe as it's falling down, and they have no way of knowing when the bottom is. Whereas a momentum buy on a value stock is basically waiting for the falling knife to come, hit on the floor, rest a little bit, bounce around a little bit, and then that's it. The fall is over. Hopefully it's rested. And even if a trend follower gets the bottom wrong, so let's say the knife rests and then it falls again, you're only out with a small loss because you had a stop loss. So you could maybe do one or two attempts to catch it on the way down, and you still have 2 or 3 small losses. But the third time you go in, and then that's the bottom, and then you're still, even with the previous 2 failed attempts to predict the bottom, you're still way ahead of just a normal fundamental value guy who has been buying it all the way down. And even if it stops going down, a fundamental guy who has bought something and is holding it for 3 years as it's holding, and it's falling, or even not falling, just sitting there, is just a dead capital. So trend following improves value investing in 2 main ways. One, it saves your hands from the falling knife. It doesn't cut your fingers. And 2, it always makes sure that the capital is efficiently allocated. You don't have dead capital for 3, 4, 5 years, where a certain value stock is still a value and it's value for 5 years, but it's not doing anything. whereas a trend follower wouldn't have done anything, and the trend follower uses that capital for 5 years on something else, and then when it breaks out and when it makes an event, then it goes in and it uses the capital alongside with the value investor guy. So and this again, amongst all the other statistical edges and factors that I've studied over the decades, momentum or trend following is the only one that one can be overlaid with every other factor. Not every factor can be overlaid with another because they're fundamentally different in logic or whatever. And two, whenever it's combined or added to whatever other factor or set of factors or strategies is, it always improves the strategy. So that says a lot.
Absolute to the rescue. Thank you. Yeah, that was, I forgot about the efficient capital efficiency, but yeah, that's basically half of what I was trying to say is that, look, we can't go around saying these markets are not predictable and let value people off the hook. They can't predict any better than anyone else. They have poor money management, it's a poor risk control. They're going to be taking these small losses are going to turn into big losses. They're going to keep buying theoretically. Do they ever stop? And so, but you can't predict how low the markets can go, irrationally low. And you can't predict how irrationally high they can go. That's what I'm saying. We'd still be in. It's no longer value. Well, let's just stay in. We bought it as value. This thing could double or triple again, even though it's out of the value range. So either you can predict or you can't with these fundamental ways. And I don't think you can. And I don't think in value is silly. I mean, I might even have I might be long some value. I have no idea. I reject all these value growth labels for building a portfolio of stocks that are diversified, different from each other, low correlations, and that have fundamental drivers that might produce some sort of, in just some sort of discretionary way, big, huge outliers that I'm going to. But then again, look, I don't have Eli Lilly because it's not a small company, and so it's like, oh, so you can maybe you can have just as great a performance and catch just as many outliers with larger stocks. So everything works. Everything works. It's small, it's large, it's everything. You're wrong, Jerry. Everything works in trend following. Oops. Okay, I'm happy to be wrong in that regard.
Hi guys. Hey Jerry. Hey everyone else. Now, I was just listening Jerry, and he was talking about this live cattle trade, and needless to say, I'm on the other side possibly, with my short-term trend following system. I'm short live cattle. We'll see what happens. It's just one out of many trades, so you wouldn't know, but it's interesting to note where things starting to move other way for the long-term systems. Usually the short-term systems can pick it up. I think the main theme of the year for me with the trend following is, naive investing approach versus trend following. Trend following allows you to trade like a pro, So this is my second year in the investing world. And what happens is, at the moment, the crypto segment has actually, going good. The Bitcoins, the other coins, they all are, trending nicely. So that's very positive. But this is the story of the October, isn't it? In September, we had this short bonds, especially long dated short bonds are trending. So that was the story of the September. Well, in August, it was long dollar exposure, especially in my short-term system. It was the main theme in terms of the trends. Well, mainly in May and June, it was the equities. So this year is basically trends are changing from one segment to the other segment to the other segment. So really, how are you going to, how are you going to trade a market like this? In my opinion, this is a huge learning opportunity for anyone else who would like to, become professional in the investing space, this year is the year. It's hugely interesting, and you can only trade it with trend following approach. You need to have exposure to the credit, to the forex, to the commodities, the equities, and each part of the year, one of those segments, asset classes have actually worked. January it was massive crypto plus equities, for instance, and then the similar thing has happened in May. So it's very interesting. The fact that this is switching on and off, it means that there is really not much room for a buy and hold investor, or anyone else who doesn't short. So the shorting is very important, and diversifying among different asset classes are very important. Crypto as a segment is very important. Trading Bitcoin is I think is no brainer. Since 2018, I think I'm adding it into my back tests, and it's really making a difference. And so that's an important point. And I think the last thing that I would like to talk about is stocks. Jerry Parker and Oleg has mentioned, they trading stocks with a single revenue stream to be able to catch those big outliers. But we also talk about trading stocks like commodities, in general. How would you trade stocks like commodities? So one thing that I'm actually working on is to be able to have stocks from different market cap buckets. So anything more than 200 billion, mega caps. So it's one. I'm trying to pick some stocks from there, and Eli Lilly was definitely there. Technology stocks are there, and then you got your large caps. Large caps are anywhere else between, I would say, 20 billion to 200 billion, and then your medium cap stocks, which are 2 billion to 20 billion, and then your penny stocks, anything else, with few hundred millions of dollars of market capitalization. So these sort of individual single name stocks all make money at different market types, and a good diversified system, I would assume, would need to have a contributor from all of those individual single name stocks. And this year we know that specifically the 7 technology stocks have made a lot of money, but also like Eli Lilly is also top 25 in the S&P 500, so it is up there. So mega caps have made a lot of money this year in terms of single name stock selection. So I don't think that it is possible to say that a good trend trader is not going to incorporate anything else on the mega caps. It's just it deserves some attention, in however shape or form that it could be. So it's very exciting so far. Every month there's a different story, and I can't wait to see what's going to happen in the last 2 months of the year. Thanks a lot for the conversation, guys. Cheers.
Cheers up. Yeah, Bitcoin, I forgot about that. It's been a big move this week. And I trade Bitcoin and Ethereum futures and a few crypto stocks. So it'd be interesting to see if they keep going, or if it's a false move, like I got with my marijuana stocks earlier this month or last month. They kind of died after the initial breakout. But this is like the rage now is. I like this idea of this return stacking, and you take passive long stocks and bonds, stocks or bonds, and you add trend following on top, a managed futures program on top. But I think my idea of trend following the stocks as well and not having anything be passive is what I prefer. All these markets, at some point in time, they need the trend following component, trailing stop stop loss. And okay, so then someone replied to this and said, Jerry, shouldn't the stocks and the managed futures component accomplish that when equity trend is down to be short in your trend following and long in your only, and long in your long only? So basically flat. Yeah, I think that's kind of true, And what he's saying is indices. Okay, so why stress over these? If you, depending upon how much indices you have, you're going to be long, you're going to be short. And so that's right. Some of these, if there's ever a big downtrend like '08, where the short indices really delivered a lot of profit in this big downtrend, being basically flat is kind of a bummer because you're not really participating in that profit that's coming from being net short. But 2008, it probably hasn't even worked since 2008 in a material way. But I was scrolling through. I hadn't, I don't trade stock indices. I used to, and then I used to trade stock index futures. I used to trade them, and I used to trade a fair amount of stock index ETFs that weren't available in futures. Sweden, Switzerland, things like that. And I just hadn't paid much attention to them recently. So I was scrolling through last night the charts looking to see what's been going on in all these stock indexes around the world. And I was just surprised because I criticized them for being too correlated. But then when I was scrolling through, I was just surprised at how correct that was. They're just all like hitting the breakouts now or recently. And so it's like one big trade on. And then I trade a lot of single stocks short. And it's just amazing the increase in diversification, because my universe of stocks, they just, when I start shorting them, they start hitting those downtrends. It's happening over, weeks and weeks and different months and months. Some of these shorts I've had on for 6 months and some for yesterday and everything in between. So the benefit of trading the individual markets on the upside with the diversification and the outlier possibilities being greater than an index, you sort of get it on the short side as well with not going short at the same time. It's really kind of interesting how it works.
Hey guys, yeah, we mentioned Bitcoin. I said this before. I would buy some Bitcoin, take it away from exchanges, put it in a hardware wallet, put it aside just a little bit, or whatever you feel comfortable completely losing. But I'll make a prediction, because we don't make predictions, but over the last 10 years, Bitcoin has outperformed every asset and strategy. I think it's 50 or 60 plus KGAR. And I predict that for the next 10 years, it's going to do the same. There's going to be no strategy or asset that is going to perform Bitcoin over the next 10 years. And I could be 50% wrong, but if I'm right, that's something significant. So put some on the side, just forget it and let it rip. Very loose pants, no strategy, just sit on it.
I hope it has a lot of big trends. I won't do that, but I will take advantage of those trends, like if it has them. And it would have been a great trend following market as well. Yeah, the first trend that it had, the cash Bitcoin was, it was, 1,000 ATRs. I've talked about it before. I don't remember if it was 1,000 or 2,000 ATRs. I'm sure the ATR was really small. And then the drawdown was just horrendous in those terms. But yeah, the drawdowns and the volatility of that market is pretty huge. But it's a great thing to add into your portfolio, like everything is. I don't really understand it, which makes it kind of the perfect trend following vehicle, because you just have to follow the trends. And but yeah, it's nice to see. Hopefully it does something. It should be a very good store of value as long as someone doesn't steal your Bitcoins. And it's true that they can't kind of flood the market with more Bitcoins like they can flood the dollar with more dollars.
Oh, Jerry, I overheard the discussion from the beginning. I wasn't logged in from the beginning, but and I just had a question or idea. I just had a thought when you were discussing or answering the question about whether or not to use the stop loss or the performance being similar with or without the stop loss, and also with a trailing stop. So my question is, so you're saying there's three parameters in the system. There's entry, stop loss, and an exit. Three parameters, very simple. So the less parameters you have, the more robust you are. However, you can trend follow, as you said, without a stop loss and even without a trailing stop. And you explained why you feel more comfortable having an initial stop loss and a trailing stop for the trade. But you also previously commented that you should be trading what's best and not what makes you feel better. And in that sense, let's conclude. The main parameter is the entry of a trend following system. Without the entry parameter, there will be no trend following system. The stop loss and the trailing stop loss are auxiliary parameters that either make you feel better or safer, or you feel like they protect your capital better, or they provide certain performance. But the other two parameters are not fundamental. They're not necessary. The entry is the only parameter. You can trade a trend following with just an entry. You cannot trade a trend following system with just a stop loss or with just a trailing stop. So to the extent that if you go to the very bottom basics of trend following, the fundamental parameter is the entry. Let's say 200-day breakout. Does the addition of one more or two more parameters, so increasing the number of parameters by 100% or by 200%, does the increase in complexity, which also decreases robustness, as we agree, do the benefits of adding the other two parameters outweigh the downsides from the decreased robustness because you increase the parameter space from 1 to 2 or 3 by 100 or 200%?
Good question. I like that. Well, you see, you've got to have an exit. So you got to have the entry and the exit, right? I mean, what do you do if you don't have an exit?
It's 200. It's same. It's an entry on the other side. Basically, you enter 200 long,
right,
and then
cool.
and then you enter a 200 breakout short. That's it. The short gets you out.
Right. Okay. Cool. Well, so adding an exit to that. So rather than going from long to short, you had the exit would be 190 days or 175 days. That I don't think changes. It's the same. You'd have the same amount. You'd have a different number of trades, but I don't think that's increasing by adding a separate exit. Okay. But however,
no, it's the same. You exit the 200, you exit the long at the 200, and you enter a new short at the same 200.
Right, but you ask if adding an exit to that and adding a stop loss to that is worth adding, given that it reduces the robustness. And I was just saying that not adding the exit. So if you go from 200 by 200 to 200 by 150. I don't think that is material decrease in robustness. Now,
well, that's an extra parameter.
That's an extra parameter, but I'm okay with that one. I think it's almost the same as 200 by 200. Now, I do though think that the stop loss is very interesting because that dramatically impacts sample size. Because 60% of the trades are losses. Now, not all of the losses are exited by the stop loss. You will have the 200-day low in this example will exit at a loss for the previous trade sometimes. However, it is a dramatic change by putting in that stop loss. And okay, and then especially if you're forced to trade longer term these days with these entry exit breakout parameters. Now, as you're forced to do that, you're also giving up more and more sample size. So the turtle systems don't work any longer. 20 days in, 10 days out, 40 days in, 20 days out. But they had a lot of sample size. So you've got to say, okay, that's a bummer that I have to leave this really high sample size to a much lower sample size and getting into the hundreds of days breakouts, kind of a bummer. Then you've got to throw in this stop loss, and that decreases the sample size by 50% at least, I would say. So, okay, so this is like a bummer, and what are you going to do? So one of the things that is interesting, though, going back to what I said earlier, like I throw this in for alternative motives, but you sort of caught me, and that is, I keep saying, well, if you don't have a stop loss, you make the same amount of money, and the average loss is about the same as using a stop loss, if you're using the stop loss that I use. So I'm trying to sort of say, oh, okay, I have reduced my sample size by using this stop loss, but not using the stop loss, it looks the same. And so I don't think that that's legitimate, that you can sort of say, well, technically I don't have as much sample size, but if I didn't use the stop loss, my performance would not be different, and I'd have this big sample size back. So is that kind of the same? I don't think it really is, but it makes me feel a little bit better. Does that make sense?
Yeah, it makes sense. But you also say that doing what makes you feel better should not be the the judge of whether you do something or not.
No, I was just, does my explanation make sense?
Oh, yeah, makes total sense.
And another thing too with these, another way of pretending or trying to convince yourself sample size is trade stocks and trend follow the stocks, because then you got thousands and thousands of markets to evaluate whether your trade stats are legit. And there's problems with that probably for most people. They would say all the stocks are the same, and I don't really think that's the case. But another thing too that you can kind of throw in there that I throw in a lot, and because I'm the one who is mostly interested in talking about the sample size and the robustness, I know most people don't really care about it as much as I do, but I mean, care about talking about it. And that is this whole idea that there is this broad range of breakout parameters that you can use, and all those parameters make about the same amount of money. So you're like, oh, okay, so maybe my sample size on the 300-day breakout is not that much, but it makes the same amount of money as the 100-day breakout. So since everything here makes all this money in this wide range of breakout parameters, maybe that is another indication that I shouldn't get too concerned about the lower sample size the further you go out on these breakout lookbacks. But I don't think that's something that's too legit either. It's just something I think about sometimes. I do think it's an issue, but maybe the most important thing is incorporate equities into your trading, all the markets and all the equities, and look at these trade stats and see and use that as evidence that you have, try to bridge that gap between trading profitable systems that have to be long-term or longer term than I'm used to trading back in the day, but have enough sample size you got with those longer-term systems that maybe you're incorporate the stock back in your back test. But most managed futures people, of course, they don't agree with that whole concept. I look at it, and I've always looked at it from this trade point of view. Trade, it's like an at-bat versus a pitcher. Count them all up, 500 at-bats in a year, 600 plate appearances in a year. I look at all these trades per year or over the back test, and that's how I come up with this concept of the sample size, where managed futures doesn't keep track of the trades any longer because there are multiple reasons that trades are getting executed, and it's really just the sample size, I think, becomes more of like, I'm not sure, adding up all those trades or looking at the dates, like how many years has this worked over the whole test period. It seems to work. So it's totally different philosophy.
Hey, Jerry, I do have a question for you. In terms of the, to you or anyone else actually interested in, we've spoken about few systems, and in the past we've mentioned the cutback rule as a defensive move. What would be the other defensive moves in the system that you think it is reasonable for a good trend following system? For instance, what about trying to enter a little bit late when things get choppy? Would you consider adding? So cutback rule is one of them. Defensive moves, cutback rule. Would you consider settling for smaller profits while your trading goes bad? Would that be an option? Or would you consider late entry as an option? What would be the defensive moves? And of course, risking smaller goes with the cutback rule. So that's risking smaller and the cutback rule is the same thing. So that's one thing. The second thing is, if you're ending up with consecutive losses, would you consider entering late or entering early? And also, would you consider settling for smaller profits until your trading gets back, based on your edge, until you actually come up with it? Thank you. Am I able to explain the question, Jerry?
You explained it, but I think that except for the one suggestion of being longer term, turn off your shorter term systems, just do fewer trades. Don't do any 100-day breakouts, just do the 200-day breakouts. The other suggestions are all the same thing. It's the cutback rule, because the cutback rule is when you have a drawdown. Well, in my mind, it's evolved a bit because honestly, I had to clarify this because I wasn't given a lot of it's a different ball game to a degree as well. Long-term trading, short-term trading. That's what we did back in the day with short-term, and having to come up with the cutback rule and how to handle that and the trade level and things like that was irrelevant when you trade shorter term, I suppose, somewhat irrelevant or much different. But part of the cutback rule, is taking positions off, let's say half your positions or 30% of your positions off, and for some time in the future, so you reduce your risk budget. Then in the new trades coming up, you're going to have those risk reduced as well. So all of those examples you gave were just derivatives of this cutback rule, and I don't really think that trading only the long-term signals is better. If you got a multi-system approach, 2 to 4. 2+ systems, or I trade 4, but I've traded a lot more historically. But yeah, something like that. I think that actually is a risk reduction measurement to trade the 100-day and the 200. But it's really interesting because I was just thinking as you're talking, like, what are the risk mitigation that we have? We have so many that's built in every single day. It's just part of what you do. You're hunting outliers, and at the same time, you've got the world's greatest risk control and money management. You've got the trade level concept. You're not trading current AUM, taking the small losses. You've got the small bet size. You got the longs and the shorts and the currencies, commodities, and interest rates, and crypto. You got this amazing diversification with shorts, stop losses, trailing stop, and you've got at the same time, You understand how critical it is. The most somewhat, I do really dislike saying the most. I criticize people all the time. Don't say what's the most important. But, obviously putting that trade on is so important, because all of a sudden, if you have that trade on, then you're starting to make money, and it's starting to pay not only for the future losses, but the losses you're currently. Yeah, so you got to keep trading and putting those trades on. And then the most important and then this initial choice of leverage, your initial choice of the risk that you wanted to take. Like I have 340 markets, and so I risk about 12 basis points per loss. And so maybe I should be risking less than that. And that's always the most important choice, is to make that choice. Are you going to have a typical day is going to be plus or minus 4 or 5%, or is it going to be plus or minus 50 basis points? So you've got to make this choice, and you don't want to overtrade and think you're going to figure a way to get out of this overtrading very quickly when you realize you shouldn't have been trading this large. So yeah, this initial choice of leverage is critical. And all of these things combined, especially the system, its win percentage, and protection of the capital with the trade level calculation, and all the things I've mentioned, it's all put together because you want to protect your capital, and also, though, you have this incredibly overriding goal of always being able to do the next trade. You've got to do the next trade. Everyone understands if you get tired of the British pound and you don't want to take the next trade, yeah, you're a dumbass, because look at that big trend you missed. But they don't sort of say, well, you overtraded. You don't have these mechanisms built into your trend following to not get into a situation where you have to do the cutback rule, because the cutback rule is a non-system trade. You're not doing those trades the way that you were doing them. You're trading them much smaller now, and that's a violation. Now, you have to do it, but you want to do everything possible to not use that cutback trade. And as I've said before, people that are not, that I met through email or something. I remember this guy who I've lost track of, Jez Liberty. He probably has his website still up, even though I didn't meet him once in New York. But he ran a test on the turtle cutback rule and said basically, the cutback rule, if you trade smaller, you don't need to use the cutback rule as much, and you end up making more money. Of course, by definition, you make less money when you do non-system trades. And it's a non-system trade. It's a overlay. It's not correlation management or vol management, which are horrible, plays havoc with your ability to do all the trades the same way all the time, one entry, one exit, and a stop loss. They don't care about that. But this is our whole goal. Don't get yourself in a situation, but sometimes you do, and you have to say, even I'll get in a situation possibly. COVID, I think, was a situation possibly at that where you say, I did everything right. Maybe I'll trade a bit smaller in the future. I'm getting a little bit of religion on that right now. Or maybe you say, no, I didn't trade too large. And but you make this cutback, and sometimes it works. Most of the time it won't work, but you have to do it in order to stay in the game, preserve your capital. And it's the perfect rule. There's no rule greater than that cutback rule. It's the best rule of all time because it works every single time. It always reduces your risk and allows you to stay in the game. And the old way of doing it was if you're down 10%, trade 20% smaller. If you're down 20%, trade 40% smaller. So you're moving that risk of ruin dramatically lower or your risk of this next fatal drawdown dramatically lower by doubling your cutback based upon your drawdown. But really, nothing is as good as never having to do that, because you had a situation where you had all these great trend following tools in place and you didn't overtrade. And a guy like Mulvaney, you see, his risk budget and appetite is much greater than mine. So I would classify a 50% drawdown as really a mistake, and I wouldn't want to get there, and I would be doing cutbacks if possible, and totally distraught that my system allowed such a thing. I obviously on record as saying I don't want that drawdown. So it's a failure on my part, whether it's the system or the trading too large. And of course, the 50% drawdown for him is a typical day or typical year. So I'm being facetious, but yeah. So you've got that piece of discretion where you have to decide for you and your clients what. Okay, sorry for all that, but hopefully I answered the question.
Yeah, Jerry, along the same lines for the cutback, it's my understanding that when you're referring to a cutback, you're referring to a cutback of a trade level, which refers to the next incoming trades, what their size should be. So the trade level changes for the new trades, whereas the current trades stay the same. Current positions you don't touch, right?
That's right. Each trade has its own trade level based upon the time the trade was put on. So I have 3 trade levels now because I'm a long-term trader. So I have trades that have been on multiple years, and I don't touch that trade. But once again, if it's a capital addition or redemption, of course I will. If you've got it, yeah.
Okay. So I have a question. Let's say there's no capital addition. Let's keep things simple. There's no capital additions and redemptions, and let's say there's a hypothetical scenario in which you have a very long-term profitable position, I don't know, like live cattle, like 600 ATR or whatever, that you've been holding for 3-4 years. And there's few of them. There's a big open profit accumulated in them. But on the other hand, the bulk of the rest of the portfolio is getting whipsawed, and it's putting a big dent on your closed trade equity level. So you said that you would adjust the trade level based on the closed trade equity. So if this other bulk of the portfolio, which is getting whipsawed and causing bleeding in the closed trade equity level, whereas on the other hand, you have a big open trade profits in these 3 or 4 or 5 markets they've been trading for 5 years. And they're also a big chunk of your volatility because they have now accumulated a lot of the initial ATR into their volatility. So would you consider at all doing something about these 4 or 5 long-term trades which have huge open profits, and you're now adjusting your trade level because your closed trade equity is kind of bleeding from these other losing ones? You're adjusting it lower, and you're not going to touch these 2. Let's say the open profits in these five markets are 30% of your AUM, okay? And no, actually the distance from the trailing stop is 30% of your AUM. So let's say you're running 100 million, you have 30 million in open profits in these 5 markets, and now so out of the 100 million, 30 million is open profits, 70 million is closed, and now this 70 million is bleeding to 60 and 50, and now it's coming down from 70 to 50, and you're going to adjust your trade level because your closed equity has now gone down from 70 to 50, even though you have 30 million in open profits. So would you lower your trade level from 70 to 50 and still leave this 30 million potential loss if the trailing stops get hit on these long ones? So I'm choosing an extreme example like this. Is there any potential scenario in which you would consider adjusting open trades as a non-system part to protect your business and to protect and to guarantee survival? Because this 30 million is now significant compared to your 50 million trade level. Do you understand my question?
Yeah, that's right. But that's the cutback rule. Yeah, so I agree. You have to, in certain scenarios like that, you would want to reduce. You would want to reduce that. You would want to reduce.
So wait. But
positions.
the cutback rule. You said the cutback rule only refers to newly entered trades, not to the established positions.
Oh no, especially to the established trades. Yeah, especially to the open trades that you have on now. Of course, you've got to decrease.
Okay. So when you decrease by 10, let's say 10% or 20%, you not only decrease by 20% your next trade, But you decrease by 20% every existing position.
Oh yeah, of course. And,
Okay. I misunderstood. Okay, good.
Yeah. No, Alp suggested that, and I just reminded, and I said yes, and then I reminded that you also decrease future trades as well. So it's first and foremost, and then of course you've got to have a good rule as to when, and this is the one that everyone used to always ask, and we never got a great answer. But when do we change the trade level? When do we increase the trade level? When we get back to equity highs or whatever. And it was a little murky. So I had to come up with some rules for that. I would just say that, once again, you don't want to get in that situation. And it is extreme. And then I've said before, in the whole entire back test, there's never been a situation which, once again means kind of, to me, it doesn't mean very much as far as the future is concerned. I'm always expecting things to look a lot worse in the future. I never rely upon the past, except I'm pretty reliable. I'm pretty obviously relying upon that the trade stats will continue. Average win, average loss, average trade, win percentage. But they may not. But I certainly don't bank anything on this stupid equity curve from the back test. I lost my train of thought. But yeah, you definitely want to make that cutback. You don't want to. Oh yeah, I've never seen a situation in history where the closed trade drawdown was greater than the open trade profit. So even when you're having a closed trade drawdown, now the one thing I thought about when you were drawing up this scenario is how important it is to have an optimal stop loss. But it doesn't still. I think our stop losses are great. They're not too small. They're not too large. They're optimal. So the chance, and we trade multiple systems. So you get a lot of failure coming. The systems, you're not getting much diversification. You're not getting very much diversification from the markets. The entry on the markets, on a lot of the markets, too many of the markets is like around the same time. So you're stringing a bunch of losses together and all these different sectors. Usually people get freaked out, including me, with just profit givebacks, open trade profit givebacks. But this scenario could definitely happen. And so you want to try to, try your best, but you still have to make this cutback. And then you have to figure, I would just classify this happening like possibly you do have a situation where the open trade equity starts to become less than your drawdown in the closed trade equity. So you haven't even lost this 30%, but you've lost 10% of it. So you're still, you still have 20% in there. I'd be cutting back then because I'm wanting to treat this closed trade equity as the most important thing. Maybe I'm not so nervous if I'm down 20% in the closed trade equity, but open trade is offsetting that by a lot. That's to be expected, but that doesn't, that may not occur. We could see a situation one of these times where you're having massive drawdowns in everything. And then I would just classify that as I made a mistake in absorbing some of that capital and including it, and my trade level was too high. And so I'll permanently reduce my trade level for the future trades and cut back on the current trades. So I don't think there's anything magical about, I think some of the rules that I have, they're rules with tremendous sample size. And so I feel confident about them. And then some of the rules don't have the sample size, but they're just rules that I'm going to implement consistently. So I know what to do, and it won't be so much emotional discretion. And I think the cutback rule is one of them. By definition, it doesn't have much of a sample size. I'm a wonderful trader. I'm doing everything right. I've never had to cut back, or I've cut back once. And so that's not much of a sample size. But I have a rule. I'm going to use it. And I'm thankful that it's a small sample size. I've told people before, like, don't vol manage, don't correlation manage, just get out. Just get out. Don't fool yourself that this is some scientific thing that you picked up in the data. You've overfitted. But if you're nervous about Eli Lilly, just get out. Just get out of a quarter of it or half of it or 10%. Feel good and walk away. You don't need a rule for something that has no sample size. It's you don't need to have a rule for that. It's bogus to begin with. So just acknowledge that and just get out of some. It's not a big deal. It's not going to ruin your life. What's going to ruin your life is this consistent application of low sample size, non-systematic trades where you're vol managing, correlation managing every day. Oh, look at this sample size I have. I know, and it's a problem. Don't do it. You shouldn't do that stuff. But if you want to do it once, sin a little. That's from Cliff.
So Jerry, so do you take both total AUM, the total performance of the strategy, into consideration to apply a cutback rule, or just the closed trade equity?
I would take just the looking at this closed trade equity and to see how if this cushion I have when I compare it to the open trade equity, the closed trade equity drawdown and the open trade equity, I would look at those two numbers. Yeah, exactly. Because I'm on record many times saying that these drawdowns are irrelevant. They're irrelevant because I didn't include that open profit in my trade level. I never got in trouble by including it. And so why do I care about it? Just having this mechanism in place and allowing to be taken out of these trades individually by the breakouts is such a superpower. You will make so much money letting the profits run and saying to yourself, who cares? If I had a 300% profit, I had a drawdown of 150%. I made 150% more than anyone else. How relevant was that stupid drawdown? It would be super relevant if you increased trades that you were doing today by that 300% open profit that you had. It would be super relevant because now you're in a situation where you're nuclearizing compounding. And compounding has a very big downside that you're absorbing equity that you've made that's not booked to increase positions. And boy, when it works, it really works well. And then when it doesn't work, you've got to go in and vol manage and correlation manage. You're doing something inherently wrong to begin with. Damn right you got to do some unfortunate things on the backside. I don't do things wrong, so I don't have anything to fix. But okay, but shit can happen, and I've got to implement the cutback rule. And I'm okay if someone says, well, then you have a problem that you need to fix. Yeah. Okay, it was my problem. Maybe I made a mistake. I traded too large. But I'm just only going to have to do this suboptimal trade, once every year or 5 years or something, hopefully. But I do think that focusing intensely on only that closed trade equity allows you the most important freedom to handle the trades the way the computer told you should handle them. You've given me the business and with this idea that you don't care about it. I care about it more than anyone because my evidence that I care about this open trade profit more than anyone is I'm willing to do whatever it takes to maximize it based upon the backtest.
Jerry, it sounds very much like Ed Secoda. He said, follow the rules at all times, but know when to break the rules. And really what you're transcribing is a sort of version of that.
So I just realized, I think this, I don't know, this could be significant or not, but there's some, or maybe I'm stupid, so I'm just realizing things. But to me, it looks like you, Jerry, are implying that the only way that you can have sample size if you remain into the additive domain of a strategy, which means keep everything fixed and hope that the sample size of your statistical edge adds value additively to your portfolio. So you're adding additively. Whereas you seem to imply or say that whenever you go into a compounding mode of a strategy, where you're not talking in terms of absolute dollars or ATRs of edge. So when you basically you're saying that in order to have a sample size, you have to remain into fixed ATR or fixed dollar notional additive domain. And once you move into a cumulative domain of mathematics, then all sample size mathematics falls into the water. And I think this is where I've been having, when I was trying to tell you that I do have sample size too, that, and which is why, okay, this is very interesting. And now Rich also mentioned et cetera, follow the rules and know when to break them. And it's exactly, if you remain constantly into the additive domain, if you remain constantly in the additive domain, you cannot have any systematic way to control your risk of ruin. That's why you have to have discretionary ways to do it. But if you do mathematics statistics in the cumulative domain, and this is where Kelly enters and the Ed Thorpes and where the mathematics goes in with the compounding and the accumulation, in this universe, this is where the math comes into play, where the question is, what is the risk you can take on a percentage basis, not on an absolute ATR or an absolute dollar basis, but on a percentage basis of capital you have available, including closed and open. So how should you manage your risk? Part of it may or may not be volatility management, but how should you manage your risk in the present time and going forward to maximize your net worth at a certain point in time and to minimize your risk of ruin? And this is where Kelly comes in. So there's a universe of mathematics that's asking and answering this question in cumulative compounding domain, whereas classical trend followers like you and Rich and others and Etse Kota say, no, there's no sample space there, there's no statistical significance there, you're going to get killed eventually. We love to stay into additive space, into not cumulative but additive, where I want to add my ATRs linearly as they come, not compounding, and keep trade level fixed as much as possible, maybe changing once a year, every 2 years or whatever, but in order for me to keep the sample size. So now I think I finally understood the philosophical and mathematical basis for the debate that we're having and what we're discussing. And I haven't really crystallized this yet. This is just a developing thought. But what do you think?
Well, this is a good topic we need to pick up later, but I can't follow everything you were saying, but I don't think that you've got to keep remembering the little bits and pieces that I say, like the negativity. Just acknowledge that there is this downside of compounding. You know, you can lose more money by increasing the trade level or using the AUM, the current AUM. And but I don't think that this particular part of our trading has anything to do with sample size. No, I don't think that's the case. I don't think of sample size when I say, well, when am I going to increase my trade level? It's that I have an edge, and needing to increase that trade level is going to have it's going to change my edge. More, maybe. Worse, maybe. I'm not sure. I just know that now I'm out of control a bit. But look, I'm very successful. I am making money for clients. At some point in time, I have to incorporate that open profit. I'm just doing it in a conservative way. Now, because you can't forget, I've said this many times, I'm discounting the trade level from AUM, increasing the unit size. So I've got the same positions on that you do, but my trade level is lower. And so, whoa. You multiply those two by each other, it's the same number. True, it is the same number, but once again, I'm a slave to consistency. I'm going to have the same unit size all the time. That's not going to change, right? And I'm going to have to increase the trade level, but I want to keep it constant, not just for money management reasons and this negativity you get by increasing it right before you have big losses, but also I want all those trades to be the same as long as possible. I have no doubt that it's much safer to trade your $5 billion with the same $5 billion trade level for your whole career, and at the end of every year, distribute that money back to the clients so you can go back and not change your positions and not change your trading size. That's the way to isolate that edge and not let it ever play havoc, this trade level choices and trading larger, needing to incorporate those profits. I'm sure that that's the safest way to go. Introducing more changes, which obviously you don't want to do that. You want to trade 10 billion one of these days, and clients love you. You want to make more money. You want to incorporate it. All I'm saying is, you're
Jerry,
getting
if I
away
could just answer what I think Absolute's talking about, what you're talking about is the way I'm interpreting it, Absolute. I think you are describing something we do think about, because I think we let the market deliver our non-linearity. We don't use the mathematics in our process to force the result. In other words, we're not using the mathematics of compounding, Kelly, embedded within our systems to force an outcome. We're letting the non-linearity in the market deliver it. So we're keeping our losses linear, all of our risk management is done at the linear level. Our profit result is an outcome derived from the market and our sort of loose pants systems, but we're not pushing the result. And, I feel that what you're talking about is the principle of getting the most optimized system in relation to, a back test, a data feed or whatever, how to maximize squeezing opportunity with a system. We're not doing that. What we're saying is the market itself has to deliver those outliers. We're not pushing the opportunity and therefore increasing our risk. So we view this as a much more conservative approach to trading, as opposed to someone who applies Kelly, someone who's trying to optimize the exponential function, the geometric return. I see where I think you are hitting on what we're trying to say here.
Okay,
yeah,
so
and that's if I could just throw in one more thing. I think that I'm not an expert on Kelly, but my interpretation, I think the one thing that I don't like about Kelly is this having to input into Kelly what's going to happen in the future. What is your expected return? What is your average trade going to be? And I think that can get problematic. So you can go long periods of time of not making money, not having those trades look like you think they should look, and there's too much claiming of what the future is going to look like. So I don't think
Kelly's like Icarus. It makes us travel too close to the sun. It's right on that verge of risk of ruin. It's optimized, sure, but it's based on a really solid, stable set of statistics to optimize that function, which we think, no, the markets are much more chaotic than that.
well,
exactly.
I would say to make the analogy with the sun more correct, Kelly is actually trying to estimate the distance from the sun, whereas people who don't use it or don't bother to use Kelly, or they think it's significant, they say, no, the sun is always high enough for me. I'll just fly low. I'll never even come close to it. Whereas Kelly is trying to say how high the sun is, and that's full Kelly. And you never have to come even close to it. You can fly at half Kelly or quarter Kelly. But knowing how high the sun is, I think is significant. And when Richard, you said,
yeah, but can you do that in a non-stationary long-term environment? That's all I'm saying.
Okay, of course you cannot to the exact millimeter and say, okay, the sun is 10 kilometers away and I can only fly 5 kilometers. You cannot say how high the sun is to the exact meter or kilometer, but you can have everything is estimates, everything is statistics, basically, in what we're doing. And when you're saying I will only try to trade try to keep fixed level, I will remain in the additive regime, even that doesn't guarantee that you're not going to get ruined, because as Jerry says, and you says, you have to have cutback rules because the system is nonlinear. Because what you think is additive
with a 3-to-1 ratio for every percent, if I'll just linearly just add to it and I don't care to compound, that still doesn't guarantee that you're not going to have a risk of ruin. You can have a risk of ruin. So you have to have protective adjustments of trade level, which now enter you into the compounding universe. The compounding universe of mathematics doesn't only address the upwards move, it addresses the downward moves. You adjust both upwards and downwards. So you're adjusting trade level when things go against you as well. So when you say, Richard, that you're allowing for the outliers to provide the non-linearity or the compounding, I think we had this argument before. And if you're trading 100 million with your strategy and you're making 14% a year, you're going to make 14 million on average a year over the next 10 or 20 years if you don't compound. So whether you're making this 14% or 14 million a year with outliers or whatever the strategies, if you don't compound and you keep
I don't see it like that, because we might have a 10-year regime of stability, like from 2010 to
But look at your
2020.
backtest. Look at your
And then
50-year backtest.
But I have, and what I do in my performance results is I see performance is related to regime. So I see
but the 50-year equity curve is a straight line. It's not a straight line. Like, there's periods of stagnation, there's periods of uplift. It looks straight simply because we're dealing with significant compounding. We're dealing with distributing outliers over the series. But when you look at it closely, it is not a linear. It's not a straight line. It's not.
Okay, leave it at that, and we'll pick it back up next week. Back to Friday, probably, more than likely, back to Friday. But this is good stuff. Thanks, everybody, for being here. Have a good weekend. See you next week.